Visa and Mastercard are two really great companies. As you can see, Visa has consistently grown earnings with only a very mild hiccup during COVID at over 19% per year. And when you look at Mastercard, you see almost an identical picture. Again, earnings grew consistently with only a slight hiccup at about 18.64%. These are two great companies, A-rated and AA rated. And what we're going to look at is which of these is the better investment or whether either of them are good investments or not in this market. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. And this is the second part of our continuing series on transaction and payment processing services companies. And as I pointed out in the previous video, a lot of the companies in this industry have seen their prices drop precipitously over the last year or so. And we talked about companies like Global Payments and Fidelity National and so on. Today, we're going to look at two stocks that seem to be oblivious to that. And frankly, they're two of the better performing companies from a standpoint of operating results, but also a standpoint of price. As pointed out in the original video, these companies have very, very consistent growth. This orange line is a plotting of the company's adjusted operating earnings. And as you can see, starting with, coming out of the recession of 2008, they grew earnings at an average rate of 18%. The earnings yield is only 3%, however. Now, that's important because the price-earnings ratio is 32. Before I go to MasterCard and look at price action, let's go ahead and look at Visa. And, it's, as the late, great Yogi Berra would say, this is almost deja vu all over again. It's very hard. Without the names, it would be almost impossible to distinguish Visa from MasterCard. But Visa is AA rated, has an earnings yield also of about 3.66%, a modest dividend yield. Visa has modest debt at about 32.8%. In contrast, MasterCard is an A+ rated company, but has debt at about 73% debt to capital. So let's review both of these companies now, and let's start by bringing in weekly closing stock prices. Now, what I want you to notice is stock prices were following earnings perfectly in 2008, 2009, 10, and 11. And then starting in 2012, we started to see this separation. And this was high valuation. But one of the things I like to point out about very fast-growing companies, you can overpay for them. Like, for example, you could have bought Visa here at a PE ratio of 27, where the theoretical fair value would have been a PE ratio of 19-ish. And still, if you held it long enough, you'd have still made money. You'd have averaged over 16% a year. The reason for that is this compounded growth at an average of 19.28% builds the future stream of income very, very quickly. But as time went on, the valuations got higher and higher and higher, and they ultimately peaked out at a valuation in the 43. The PE ratio was 43 by, July 2021. And then, of course, we've seen a correction there. Now, let's go ahead and let's look at MasterCard and put it through the same microscope, as you will. Once again, you see price-tracked earnings very, very closely through 2012. Then we saw the separation. But you would see this same continuous growth and continuous rise of the stock price. All right, so, valuation matters and matters a lot, I've often said. But when you're dealing with companies that are growing at rates above 15%, we use the old Peter Lynch P equals growth rate ratio. So the price earnings ratio for fair value on MasterCard on this time frame was 18.6. The fair value valuation, in contrast, for Visa, which grew a little faster at 19.8, was 19.28. Okay, and it consists of the PE ratio equal to the company's growth rate, or a PEG ratio of 1. That's what that orange line would represent. Now, even though the stocks were overvalued, this is what a lot of people don't understand about valuation. Valuation is about participating fully in the business of the company. If you'd have bought Visa back here, when it was fairly valued at around an 18 PE ratio or a 19 PE ratio, and held it through, let's say, the end of the year, you'd have averaged about 18% a year, something very close to the growth rate of the company. You'd have bought that stock at the overvaluation it currently shows at, you'd have made over 22% a year. The point is you're fully participating in the growth of the business. But watch, I want to show you what happens when you look at buying this stock. Let's say you bought it just before COVID hit. and you bought it at a very high valuation, a PE ratio of about 39. All right. Over the next 1, 2, 3 years, 3.5 years, you'd have held that, you'd have only made 3% a year. And my point is, and what I say, fundamentals matter and they matter a lot, but so does valuation. Valuation matters, and it matters a lot. And I often say when you're measuring performance without simultaneously measuring valuation, it's a job half done. So the point is, Visa is still as great a company at this level as it was at this level. It's growing earnings at a very attractive rate, very consistently. Notice the dividend line, consistent growth in dividend, even though it pays less than 1%. A lot of that less than 1% yield has to do with the fact that the stock is so overvalued. If it was more fairly valued, it would probably be more market neutral. As you can see, the area below the white line is the payout ratio. The payout ratio has been very, very low. And we do the same thing when we go to Mastercard. Once again, buying it around COVID, holding it to here, you make 3.5%. So what's happened is you've got a great company, but because you would be overpaying for it around here, you are turning it into a mediocre investment. And that's the point I want to make. And similarly, you've got less than a 1% dividend yield here, 0.61, but that's predicated on the fact that the stock is so overvalued. If I bring the dividend yield line in, you can see that, when the stock was more reasonably priced, if I can hit it here for you, let me take the price off the graph, it'd be easier. When you looked at dividend yield here, it was still very, very low back then because their payout ratio back then was only 3%. My point being is that we're looking at a stock that is not really a dividend stock, it's more of a growth stock, okay? And so the dividend has grown. And let's go ahead and look at performance over this time frame now. We'll start with Mastercard, then we'll move to Visa. Mastercard, if you'd have bought $10,000 worth on January 2nd, 2009 and held it to yesterday's close, that $10,000 would have grown to $251,128 versus the S&P 500 quadrupling your money over that time frame. So that's really great performance. That's averaging over 25% a year compared to a market that did over 11, which was a very high rate of return for the market because the market was showing some overvaluation. But notice the dividend yield. Notice how the yield on cost increased from 0.4% up to 13%. So that's Mastercard. Looking at Visa from the same perspective, we get a very, very similar picture. $10,000 grew to $159,000 versus $39,000 with slightly different time frames here because of fiscal year adjustments. But we end up with 21% versus 10.76%. And once again, a dividend yield that grew from less than 1% to over 10.5%. But the point I want to get across here when I'm looking at both of these companies is the similarities in the company. And the point I'm trying to make at this level is, even though these are great companies, because of the high valuation, they have really not been that great of an investment. Even if you'd have bought it back, in, let's say, September of 2008, and that's the fiscal year for Visa, and held it to now with the overvaluation, you would have made almost 10% a year, but you earned less than the company generated in terms of earnings. Because if I scroll this back here, if I use my scroll bar feature here and grow this to that time frame, Visa grew at about 16% a year, and you'd have made less than 10. That's because you overpaid for the stock. Okay, that's the point I want to make. Valuation is a matter. So I love these companies. I just don't like the way the market's valuing them. And by the way, they have had, some weakness here in the recent year, as you can see, but they never got really close to fair value based on adjusted operating earnings. All right, but let's run both of these companies now through the mill on other metrics and see how they stack up. Now, when I look at the normal price earnings ratio, how the market's priced it, the market's priced it on average at about 27 times earnings. It was 19 times earnings back here, but it was, 27 times earnings. That's what the blue line is. So these are valuation reference lines that you analyze. And you can see this has been trading at a very high valuation for many, many years now. And that's something that you need to simply accept and adjust. But let's run it through some other important metrics. Now, if I run it through cash flow, if I run Visa through cash flow, I get a total different perspective of valuation. I still get a high level of valuation in 2021, 2020, et cetera. But based on operating cash flow, Visa looks a lot more attractive. Now let's put Mastercard through that same process here, because we're doing a comparison here. And part of what we're going to try to accomplish here is which one of these companies is the better investment today, or which one of these companies is a good investment. So if we go to operating cash flow, Mastercard looks a little more fully valued compared to Visa, which actually looks slightly undervalued. And again, Visa is AA rated, Mastercard is A+ rated, Visa has 34.8% debt to equity, Mastercard has over 73% debt to equity. All right, let's go ahead and run, while I'm here, we'll run Mastercard through earnings before interest, taxes, depreciation, and amortization. We've got 16.6% growth. We still see high valuation. I take Visa and I run it through EBITDA. I get, a similar thing with about 17% growth. These numbers, change because of the differences, slight differences in the company's growth rate. And, Mastercard has a fiscal year of December. Visa has a fiscal year of September. So, that also changes the calculation of these growth. But my point is these companies are very, very similar, more similar than they are different. Now, if I go ahead and finally look at another metric that I like to value stocks with is sales, we see that on a price to sales basis, Mastercard is trading at a very high price to sales basis. And if I look at Visa and go to price to sales, I see that Visa also is trading at a very high price to sales over the last 7 years. So the point of the story up to here is that both companies are excellent companies. Visa, actually, there could be an argument made for Visa, I want to point out, that if I looked at Visa from a standpoint of operating cash flow, which also, by the way, shows that they're covering their dividend very well, Visa looks attractively priced, where in contrast, if I look at Mastercard in terms of operating cash flow, it looks slightly overvalued, but still reasonably valued based on cash. Okay, so, the reality is both of these are very, very comparable companies. What we're going to do now is I'm going to turn this over to my son, Colton, and he's going to go through the financial statements. And what we're going to try to establish through the financial statements is which companies have, better balance sheets, better financials overall, which of these two companies would make the most sense from a quality standpoint based on fundamentals, financial fundamentals, which would be the better companies. Let me now turn it over to Colton.
Hey everyone, Colton Carnevale here. So as Chuck said, I'm going to take a look at the financial statements for both Visa and Mastercard. And, you can find all of this financial statement data under the financials tab and then financial statements under Fast Graphs. So what we're going to be looking at is primarily the balance sheet and the cash flow statement in terms of quarterly data. So all this data that I've pulled into the spreadsheet that I'm going to show you, which I've pulled it in the spreadsheet just to run some quick calculations, can all be found on the, right here in Fast Graphs. And then we're going to go take a look at some fund graphs for profitability ratios and things like that to also compare these companies. Same in profitability and liquidity ratios. So dragging in this Excel sheet, what I've done is I've taken a few accounts from the balance sheet on both Visa and Mastercard to compare, and then same thing with the cash flow statements for both. So taking a look at Visa, first of all, and its balance sheet, we've got cash and short-term investments up here, and we are looking from quarter 2 of fiscal year 2019 up to quarter 1 of fiscal year 2023. One thing I do like to see from this company is the growth of cash and cash equivalents, short-term investments that this company has on their balance sheet. We saw it started low, it kind of ballooned up a little bit, dropped again, and then kind of rose again and maintained. But overall, from quarter 2, 2019 to quarter 1, 2023, we see a 56% growth in cash and short-term investments. Jumping right over to Mastercard, we only see a 6% growth during that time for Mastercard. So they grew from $7.1 billion to $7.5 billion. Coming back to Visa, remember, $12.2 billion to $19.1 billion. So already just looking at cash, from a cash perspective, Visa looks a lot better to me. Visa is growing its cash balance, and Visa is quite a bit more liquid. And we'll see that even more once we take a look at the rest of the balance sheet. So accounts receivable, we are looking at, a little bit of a growth as assets have grown, accounts receivable have grown. But down here, in this line right here, we can see the percent of total assets. So accounts receivable are making up a very small portion, 5-6%. and more recently 5%, whereas cash has grown, from 17% of total assets to 22% on Visa's balance sheet. Now, taking a look at Mastercard's cash has dropped, right? Their asset makeup has changed, and we're going to take a look at that in a minute on fast graphs. But their asset makeup has changed. Their cash has barely grown, but their assets have been increasing, and their accounts receivable as a percent of total assets is a lot higher. So that means they have a lot more people owe them money essentially than Visa. So in a way, Visa's more liquid, Visa's more secured balance sheet, and just from an assets perspective, Visa, comparing these numbers has, in my opinion, a better, at least asset portion of their balance sheet compared to Mastercard. Taking a look at the rest of the balance sheet, we've got long-term debt right here, excluding lease obligation, total liabilities, the growth of the total liabilities, and then long-term debt as a percent of total liabilities. So long-term debt has been growing a little bit, and then total liabilities have grown for Visa by 37%. That was a big jump, a lot faster than the assets have grown, but it's still not necessarily a bad thing. If we skip ahead a little bit, the total assets to total liabilities ratio, they've dropped from a 1.99, a 2 down to a 1.8. So they still cover their liabilities pretty well. They're still more asset and equity heavy than what Mastercard is. And let's go take a look at that right now. So looking at Mastercard's balance sheet, the total liabilities have grown at 71%. That's a lot larger than the 37% that Visa's has. And the long-term debt as a percent of liabilities is, roughly the same, but their debt seems to have grown quite a bit more. It's basically doubled versus, not as large of an increase from Visa in itself. And then looking at the total assets to total liabilities, 1.8 compared to 1.16. So once again, Mastercard is a lot more liability heavy than Visa is. We've seen that in debt. We've seen that now in, Mastercard is a lot more liability heavy than Visa is. So, in my opinion, Visa's balance sheet is a lot healthier than Mastercard's. And, even including this portion of the assets, right? Accounts receivable, I think this is a big portion to kind of look at. Accounts receivable being a lot less of their assets is a safer thing, right? They're more liquid. They have more money now. They don't have as much money outstanding that, they're waiting on customers to pay them. So one thing I do want to look at is Mastercard's balance sheet and some of the increases in assets that we've seen. So if we take a look at quarterly and come down here, their asset increase has been, once again, 57%. And that's compared to 23% of Visa. But one thing that I want us to pay attention to, what has grown mostly, is if we come down to this intangible assets and this tangible other assets, but more specifically intangible assets. Their intangible assets have grown from 4.7 billion to 11 billion. That's a huge growth. And their net goodwill has grown from 3.5 billion to 7.5, while their other intangible assets have grown from 1.2 to 4 billion. And we'll get in a second to what these other intangible assets are. But net goodwill represents, in a way, how much they've overpaid for companies that they've acquired. There's a market value that is paid, or that a company is valued at, but that doesn't mean that a company will acquire, said company for that market value. They could pay it, let's say the market value of that company's book is like $1 billion and they pay $2 billion for it. The company would put $1 billion in net goodwill. So this represents, in a way, how much they have overpaid for the market value of companies. And it's like a sunken cost. It's sometimes maybe not necessarily like a good asset, but it does get recorded on the balance sheet as an asset. So for us to figure out what other intangible assets are, one thing that we can do is go to Edgar search from this dropdown, and we're going to have to look at the 10K. I know we were looking at quarterly data, but this field only shows notes on a 10K. So if we go here, look through documents, go into here, and then look up other intangible assets. There is a table on here that we can take a look at that represents what these other intangible assets are. So this note 12, other intangible assets. This is representing capitalized software. So what capitalized software is there's an accounting rule where companies that produce software can technically put the development costs and everything, they can capitalize the development costs and represent that as an asset on the balance sheet. So they're in a way inflating their balance sheet this way. Customer relationships, this is representing some sort of value of customer relationships and could be inflating their, balance sheet even more as an intangible asset. So once again, we saw this large increase in assets from Mastercard, a lot larger than Visa's, but it's mostly from that intangible assets, mostly from the other intangible assets from capitalized software and customer relations, and then also goodwill, whereas Visa had a growth in assets, but a significant growth in cash. So this company is way better set up from a balance sheet standpoint, Visa is. And then, they've got a lot more cash ready to roll. And they're, at the end of the day, the total assets to total liabilities is just a way better figure for Visa. Now, if we go take a look at fund graphs and take a look at both of these companies and take a look at their liquidity ratios, specifically their current ratios, their current and quick are going to be the same. These companies don't have an inventory, which the difference between a current ratio is current assets divided by current liabilities. Quick ratio is current assets minus inventory divided by current liabilities. So once again, there is no inventory for these companies. So we're just going to take a look at the current ratio. So let's take a look at quarterly. We'll look at the last 11 or 10 quarters. So, it's gone from 1.85 down to 1.2. So this is still, even though this has dropped, this 1.2 is still a healthy current ratio for MasterCard. But, we are seeing a drop in liquidity for MasterCard. Whereas if we take a look at Visa, Visa has gone from a 1.9, it's dropped in liquidity, but has started rising in liquidity again. So 1.5 compared to 1.2, liquidity-wise, from a current asset to current liability standpoint, Visa is once again taking the cake from a balance sheet perspective. The last thing that I want to look at is the gross operating and net margins for these companies. And what we'll do is open up a new tab and just jump in back and forth between these companies to compare them. So if we take a look at Visa, their gross margin has been hovering around, mid to high 70s, and it even increased a little bit here and dropped here. We've got a compound annual growth rate of just under 1%. So we're seeing a margin increase here. So 75% in the most recent one in terms of gross margins. If we come take a look at Mastercard, so Mastercard on their income statement did not have gross profit. FactSet doesn't seem to source that data. I haven't looked into that, whether that's actually available or was not reported in a way by Mastercard for our data provider to pick up. But in the most recent quarters, we are seeing a lot higher of a gross margin than Visa. So in a way, Mastercard from a gross perspective, from a gross margin perspective, is a lot more profitable. Now, if we start taking a look at these other ones, operating margin and net margin, this is including more expenses now. And, it's further down the line on the income statement and ultimately the bottom line profitability of these companies. We're looking at a increase here of about 3% compound annual growth rate. And then as for their net margin, they've been increasing their net margin fairly healthily by 11%. And we're sitting at 67 and 52% on Visa. Now, if we take a look here for MasterCard, the growth of their margins have been flat, both net and operating margin, and they are less profitable than Visa as a whole. So from a income statement perspective, I'm going to give Visa the better rating than MasterCard. They're both fairly profitable, net margins of 40 and 50%. They are high. It's not like MasterCard is an absolutely horrible trash company. But if I'm going to compare the two between each other, Visa is going to take the cake in that. So the last thing that we're going to take a look at is the cash flow statement for these two companies. The way I've set this up is looking at the quarterly operating cash flow and then summing the last 12 months for these. This is done on both companies, doing the same thing for investing, financing, and then ultimately net changing cash. This exchange rate effect has to do with, selling internationally, and then it's adjusted back for exchange rates and whatnot. So it's just to have the numbers match what the last change in cash is. It's a small exchange rate adjustment that is made to these values. So looking at the first one and comparing the two, we have seen a total growth, and we're looking at, remember, last 12 months of operating cash flow. We've seen operating cash flow grow from 12.7 billion to 19.1 billion for Visa. If we take a look at operating cash flow for Mastercard, we've still seen a healthy growth rate, 39%, growing from 8.2 to 11.4 billion dollars. But Visa has grown their operating cash flow a lot more, 50%. So quite a bit faster than Mastercard has grown theirs. Investing, for both of these companies, I'm not really going to worry about this. Last 12-month investing, it's hovering from 2.3 billion in outflow to 1.5 billion in outflow for Mastercard. Roughly the same. Visa actually had some inflows back here and then have been outflows. This isn't really anything to really worry about or look at, but let's look at financing. So both of these companies have large last 12-month financing outflows, tens of billions of dollars, and MasterCard has definitely ramped theirs up compared to what Visa has done. So one thing that I do want to show you guys is going back to the financial statements. So right now we're looking at Mastercard and looking at the cash flow statement. One thing that we are going to see on both of these companies is a large change in capital stock. And remember, this Excel spreadsheet we were looking at was a last 12 month. So it's, these last four summed up. So we'll see the same numbers here. Sorry, this is Visa. We'll see the same numbers here in terms of financing cash flow. So negative 1.95 billion, same here. So, but I did want to point out what is happening is these companies are spending most of their financing outflow on repurchasing stock, right? Mastercard is spending, 2.8 billion, 2.4 billion, 1.5 billion these last few quarters. And if we go and take a look at Visa on their cash flow statement, we're going to see something similar. They are spending, 2.1 billion, 3 billion, 2 billion, so on. But one thing to pay attention to, what this has been doing to their balance sheet, is if we run over to Visa's balance sheet now, one thing that we'll see in going down to total equity, we have this retained earnings right here, and then nothing really on here that's reducing their shareholders' equity. What's happening on Mastercard, though, is if we take a look here, we will see that there's this giant negative value of treasury stock. So Mastercard is holding on to their treasury stock that they're buying back, and Visa is not. Visa is retiring all of that stock, and it's leaving the balance sheet. So that's one form of what's happening on the balance sheets that I also wanted to bring up, which can affect the ratios of the balance sheet. Visa can always issue more shares at that point, but Mastercard does have some, powder in the keg, essentially, to sell some stock on the secondary markets and raise some money if they need to, whereas Visa would have to go through another offering or even raise debt. So that's what I'm seeing with these financial statements. I still think, even with this last little caveat at the end, I'm going to give Visa from a financial statement perspective across the board, I think Visa is better. I think the balance sheet is set up better. I think the profitability of the company is better. And I think, the cash flow generation of Visa is better than MasterCard. So with all that being said, back to you, Chuck.
All right, thanks, Colton. That was really excellent. Appreciate that. And that gives the viewer here a perspective of what the companies look like on a comparable basis relative to the quality of their fundamentals. But now let's look at going forward. And this is the point I want to make. Going forward, Visa is expected to grow earnings at around 14% a year. Their long-term growth rate is expected about 16.5%. Both of those numbers are excellent numbers. I want to make that clear. And from that standpoint of view, you have to really say these are really great growth stories, and that consistency of that growth looks like it's still going to be there. Mastercard is actually expected to grow a little higher over the next couple of years, a little faster, and their long-term growth is expected to be higher at 20% also. And by the way, this means you could make double-digit returns buying Mastercard today as long as you held it through thick and thin all these years. And the company achieved, an average of 20% growth. And when you look at Visa, expected to grow at 16%, you get a similar 7% rate of return, assuming. Now, if you applied normal multiples in the 24, 25% range, assuming they would hold that, like in Visa's case, the normal multiple over the last 5 years has been 33. So if we, look at that going forward, we could see an opportunity to make 24 or 25% a year. If we ran Mastercard through that same process with a normal multiple of about 36, we would get the same double-digit 20% numbers. But those numbers are very, very strong, and that valuation is very, very high. And what we're assuming is that what's happened over the last 5 or 6 years, 4 or 5 years, is going to persist into the future. You're not going to see what happened to companies like Global Payments or Fidelity or any of the others that we covered in the previous video. We have seen some weakness for the last couple of years. Now, there's another issue here that I think is worth talking about. But before we do that, we're going to go in and we're going to go through the external links using the external links capability of fast graphs. And let's look at what other services let's look at what Morningstar has to say about Visa. And I think this is very important. Now, everything I've said so far shows what a great company it is, but they only give it 3 stars. Okay, they say the last close was 226. They give it a fair value of 241. But again, 3 stars is like average. Same with Mastercard. If I go to Morningstar and look at Mastercard, Morningstar gives Mastercard equivalent 3 stars. That simply means that because of high valuation, these stocks are not the supreme investments that they've historically been, especially if you could have bought them back here at reasonable valuations. This is where you would have had the opportunity to make a lot of money in both of these companies. So, the bottom line is it's up to you, whether you would. I think both of these companies should be on your wish list, if you will. I'd love to own either one of these companies if I could buy them at a reasonable price. And again, I don't have to be as fastidious with, valuation with the companies that are growing as fast as these two are, but I still got to be reasonable. I'm not willing to pay 34 times earnings or 33 times earnings to buy Mastercard, nor am I willing to pay 27 times earnings to buy Visa, but I'd be a little more willing to buy Visa at this point than Mastercard. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. I hope you enjoyed this, and I hope you recognize that valuation impacts investments. Just because a stock is overvalued doesn't mean you can't make money. But what it does mean is you probably stand to make less money than you rightfully deserve, or less money than the company is capable of generating as an operating business. And, we should all be looking to position ourselves. If we're going to identify a great company and you want to invest in a great company, let's participate fully in what that company is capable of delivering to us. That's what value investing is all about. If you like this video, hit the subscribe button, give me a like, and take a look at FastGraphs. What a great, powerful tool. As you can see through what I went through and also how Colton went through the financials with you, you can analyze stocks deeper and faster and more efficiently with FastGraphs than any other tool I'm aware of. Thanks for watching. We'll talk to you again real soon.